Palantir stock making new lows, down over 20% today. In just the last few months, it's down over 70%. Investors are wondering what's going on. I'm going to talk about their most recent quarterly results in this video. I'm also going to talk about why the stock's down so much. I'm also going to share my personal thoughts on the valuation. In full disclosure, this is not financial advice. If this is your first time tuning in, my name is Daniel. You're watching Unrivaled Investing. This is a no-hype, mission-focused channel trying to find you exceptional companies and unrivaled investments. A lot of folks got caught up in the hype with Palantir saying, rah, rah, this stock's amazing, while ignoring, I'd argue, the fundamental valuation framework that you need to consider when you look at any company. And Palantir, while they continue to grow, the stock is getting hammered because they were arguably overvalued in the past. And I'm going to talk about that dynamic and more. I personally think, looking at Palantir now, and keep in mind, once again, not financial advice, looking at Palantir now, I do believe it has the potential to outperform the major U.S. indices, let's say over the next 5 years, given the dynamics that we're going to talk about in just a second. So if this is your first time tuning in, please make a point of hitting that thumbs up, hit that subscribe button. So let's understand what is going on with Palantir stock. First of all, their valuation has gotten crushed, and this is a main reason why the stock's down so much, is that the valuation was just too darn rich. It was trading around 50 times sales. And I had done several videos warning investors saying, hey folks, look, I have a personal background. I previously worked at a multi-billion-dollar hedge fund. I've also worked as a CFO at a startup that grew from a couple $1 million in revenue to $40 million in revenue. So I have familiarity with fundamentals and thinking about the valuations of businesses. And there's a lot of folks here, hypesters, that are like, rah, 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 this stock at 50 times sales, this is amazing. Go to the moon, 20 times sales, go to the moon. I'm like, folks, check the hype at the door. This is a no hype, mission focused channel. Let's try to understand what's actually going on. So let's dive in from here, understanding that the valuation has come down like 80-90% because it's gone from 50 times sales now to under 10 times sales. Let's understand what's going on, from here to think about where does this go and why is the stock getting hammered. So looking at their first quarter 22 results, they are still posting really solid growth, 30% plus revenue growth. Commercial business growing 54%. U.S. commercial, so this means U.S. commercial, like U.S. customers that are not government, growing 136%. This, when I see a data point like that, that means they are taking market share. That means they do have a strong value proposition. That's what I want to find with my own personal investment journey. I want to find unrivaled companies that can grow faster than the market. And when you're unrivaled, it gives you that right to grow long term. So seeing data points like that, that does reinforce the thesis that they're doing something special. Now, maybe it's a software, maybe it's their sales force, maybe it's a combination of the two, but they're doing something special here to grow that quickly. And another core aspect here on why the stock's gotten punished is that they're still unprofitable. They do talk about phony baloney, adjusted profit margins where you add back huge amounts of stock-based compensation. Once again, check the hype at the door. This is a no hype channel. Stock-based compensation is a very real expense. So when I look at this business, I'm saying, no, I'm not going to be adding back stock-based compensation. I'm going to look at your actual profit margins to try to figure out where's the stock go in the future. And so look, this is still unprofitable. And in this market, a lot of unprofitable stocks just are getting penalized, partly because when you have the market like we're in now, potentially facing a recession, we're in a bear market now, I'd argue, is you want to have those cash flows so that way the CEO has the opportunity to rapidly buy back stock. Yes, management talks about being free cash flow positive. You check the numbers. The reality is last quarter, they only generated around 15 million in free cash flow. That is not a lot of free cash flow to buy back stock. Now, they do have some cash on the balance sheet. That's okay, but I'd rather to see the actual free cash flow from operations. And at this point, this is still an unprofitable business. And another core aspect why the stock is down is because they're guiding to only 25% growth in the second quarter, and this goes against management's sort of long-term perspective that, hey, we think we can grow greater than 30% long-term. That's what Alex Karp has said. So saying, oh yeah, only 25% next quarter, that is a little bit disappointing. Now, part of that's, from the timing of government spending. Maybe that picks up in the second half of the year, but we'll see. And so this is a core aspect on why it's going down. Slightly slower expectations as well as a big hit to valuation. Another core aspect to consider on why I think you're looking at Palantir go down is the fact that you have this sort of philosopher CEO, talking about all sorts of random stuff on the call. He's talking about food shortages. He's talking about nuclear events, saying raging inflation, the odds of a nuclear event are so much higher than is being presented to the public, and Palantir is playing a crucial, and much bigger role than we're allowed to mention. And he even has time on the call to talk about the metaverse and how we're not dealing with a meta world or a theological world or a financial version of a theological world or grad school version of a theological world. I look at this and it's funny to sort of throw some shade at Zuckerberg, and I think Alex Karp thinks he's dropping these truth bombs over here, but the reality is Wall Street doesn't care for this. Wall Street does not care for these truth bombs that you think you're dropping. And I think Alex Karp is sort of this mad scientist. And, at this point, you have Wall Street previously going, whoa, super cool mad scientist. Now people are sort of waking up saying, wow, this guy's all over the place. He's kind of, I think he's on the spectrum. Nothing wrong with that. But I'm just sort of saying these letters that he writes, this sort of off the cuff remarks, this has nothing to do with Palantir as a thesis, right? Does this make any sense? Well, actually, I think in sort of that scatterbrained approach to mentioning all these things, he's actually trying to say, yeah, a lot of this actually does have to do with Palantir, because, what he's trying to say is when there's real problems, when stuff happens, who are you going to call? And he's saying, yeah, Palantir is going to be the one when there's a problem going on in Ukraine. Yeah, our software is going to be deployed, and we're going to be, the ones trying to solve these problems. And so, as an example, one of their commercial customers, Pacific Gas and Electric, using Foundry, they talk about how Foundry is our central platform for data-driven decision-making and situational intelligence. They're saying this is critical for helping them manage, climate threats and ever-changing risks of wildfire in California. And by providing the critical software infrastructure for these businesses as well as governments, it's resulting in a net dollar retention of 124%. So that does mean not only are you growing quickly, like I've called out previously, but they have this strong stickiness with their customers, where their existing base of customers are spending more with Palantir, spending 24% more this year. So this business would have grown by 24% without adding any new customers. That's what that 124% means. And so this means, look, this is a critical platform for when you have real problems that you have to deal with. So then the question is, well, what's the right value for Palantir as we weigh the different fundamentals? First, a quick plug where if you're either struggling with this current investment environment, where you're just trying to protect your investments, your savings, or you want to find potential multi-baggers, the types of stocks that could potentially go up hundreds or even thousands of % over time, go to unrivaledinvesting.com. I have this weekly letter that goes out to the Unrivaled Investing subscribers. I also share my personal investment journey, so you can see, what are the value investments that Daniel's making? Also, what are the hyper growth things that I'm considering for my real money portfolio that I call out, weekly to the Unrivaled Investing subscribers. So once again, that's unrivaledinvesting.com, and a big thank you to the Unrivaled Investing subscribers that keep this channel going. Without them, there wouldn't be this video. So thanks so much if you're an Unrivaled Investing subscriber. And so when you think about Palantir, first of all, this is critical software infrastructure across the board, whether or not it's, geopolitical conflicts or manufacturing or dealing with potential wildfires. So you're looking at them rolling out critical software. This is going to be sticky. They're going to keep growing. That's sort of the perspective. And you look at this and you see total government revenue growth of 16%. That is a bit disappointing, but part of that is just hey, how fast does the government move? When are you going to win big contracts? But their total commercial revenue growth was really nice to see, 54% growth. Once again, this reinforces that they are taking market share, that they have a strong value proposition. And so as I consider looking at this, looking at, once again, a hypothetical valuation framework, of course, stock prices can go way higher, way lower. Looking at the price now, around $750 a share, I'm looking at this and I think you can pencil out up over 100% upside over the next 5 years. Now that the stock price is where it's at. So looking at this, a lot of folks get confused about the actual fully diluted shares outstanding. You need to look at the latest, the 10Ks and the 10Qs, look at anti-dilutive securities, and you realize that there's hundreds of millions that need to get added back there to think about their real market cap. So their real market cap, ignore what you see in a lot of different YouTube videos or, on different financial services. Calculate it yourself. It's currently around 2.5 billion in terms of fully diluted shares when you consider the anti-dilutive, shares as well. I did a whole video on that. The one that was, the big belly saying there's an overhang. That's, check out that video if you want to understand it in greater detail. So overall, this business is still valued close to $20 billion, even at $7.50 a share. Potentially, 25 to 30% growth. This year, 2022, they're guiding to around 25% growth. This next quarter, 30% plus for the first quarter. So I'm saying 25 to 30% this year. Long term, I'm saying they can get to 25 to 30% margins. Maybe they'll do that. They have gross margins of around 80%. So this will require them to continue to say, hey, we're not going to spend all of our gross profit, and we're going to slowly build up our actual operating profit. Now, management has talked about the importance of being a profitable company. So I think it is possible you see, attractive margins long term. That said, this is a show me, I need to see them continue to execute. Their margins have improved, but this is still a very unprofitable business when you look at it on a GAAP earnings perspective. On a free cash flow perspective, they're slightly above break even, but part of that's also because significant amounts of stock-based compensation. So looking at this now, it's trading under 10 times sales. If you were to adjust, for a hypothetical earnings, what they could be doing if there are 25 to 30% margins right now, then you'd say, yeah, it's trading around 40 to 50 times adjusted earnings if, they were able to get these types of margins, today. They're obviously not. So then the question is, what's the growth rate in the ensuing years? Because I always like to think, look out over 5 years. I try to be a long-term investor. And so I'm saying, yeah, let's give credit to Alex Karp saying, yeah, 30% growth. So I'm sort of pinning that as the sort of central case, saying maybe a little bit below, maybe a little above, that sort of growth rate over the years ahead. And saying, yeah, what's that earnings multiple 5 years out? Somewhere between 20 and 30 times earnings. That's what I'm saying, because, maybe their growth rate, a few years from now is closer to, 5 years from now is closer to 20%. What's that end multiple? And you can make your own assumptions. And if you have a strong opinion about where that earnings multiple should be, I'd love to hear it. But, try to make sure you're not letting, the dark side of hype cloud your perspective when you say, oh, this should be at 60 times earnings. A lot of people were like, Daniel, your earnings multiples are just way too low. And I've been hearing that over and over again. But the reality is no, I think I'm trying to ground this in a conservative reality when I look at this. So I look at this and I'm thinking, Palantir has the potential to grow at a very good and fast clip in the years ahead. When you compare that to a broad-based index like the S&P 500, the S&P 500 long-term, you're looking at around 6% earnings growth. And so, 30% versus 6%, that's part of the reason why Palantir has the potential to grow faster, I'd argue, than looking at something like the S&P. Now, you always have to factor in not only fundamentals, but you also have to factor in that valuation. And now the valuation has come down so much, that's the reason why over a 5-year time frame, it wouldn't surprise me to see Palantir outperform, let's say, a major index like the S&P. And I think the S&P could have a very lousy return over the next few years. And so I'm considering all these aspects, when I'm looking at it. I personally haven't yet pulled the trigger for Palantir, partly because I want to own things. Like, first of all, I've called out to my Unraveled Investing subscribers for months now that, I thought there's this huge dislocation in the market, caused by the Federal Reserve effectively overinflating assets. And now a lot of that froth is going to be coming out. So when there's a bottom, I want to just get crazy bargains. I want things that are just really dirt cheap. And so that means you have real free cash flow and you get real earnings multiples. And so if I do not have real free cash flow and real earnings multiples, like arguably right now, they're just the free cash flows okay for Palantir. It's not like they're making hundreds of millions in free cash flow. But when, with this current setup with Palantir, I'd want to get a discount for that. I'd say, okay, so I want to factor that in. So I want even more upside from what I'm looking at. So I'm not ready yet to pull the trigger on Palantir. I'm not really sure, but maybe when I'm penciling out like 100% upside in my low case, then I'd say, oh, okay, this is a little more compelling because I'm being compensated for that risk, for that assumption that they ever achieve profitability. And that's a core aspect in this market. And where some value plays, and I call them out to Unravel Investing subscribers, some of the things I own where they actually have the free cash flows now. Where it's like, hey, this trades at 13 times free cash flow. This trades at 15 times free cash flow, and they're growing. So that's part of the reason why it's like, okay, would I rather own something that, let's say, is growing 5 to 10% a year, but trades at 13 times free cash flow, or would I rather own something that's unprofitable and growing at 30%, and maybe the valuation's too rich? We'll see. In a bear market, oftentimes you struggle to get that. Where does the buyer step up, because folks say, well, what's the fundamental value here? And a lot of people are asking themselves, well, where are margins? And when you don't actually see that profitability, you can have huge fluctuations. And that's part of the reason why Amazon stock during the dot-com bubble dropped 90%. It's because people didn't know, well, what's the margins for this business ultimately shape up to be? And so they're like, well, I don't know, I'm going to, bail out of it. You're seeing that with a lot of these unprofitable companies. You might continue to see it. I'm not yet ready to pull the trigger. That said, wouldn't surprise me to see Palantir stock outperform the major indices in the years ahead. If you enjoyed this video, please make a point of hitting that thumbs up, hit that subscribe button. Thanks so much for tuning in.